New strategy, crude oil, Cobra Crude with VWAP. It's a variation of Cobra Crude. Developed it last week, actually the last couple of months, and have been kind of watching it and decided to move forward with this strategy. It is not in the portfolios yet, but I may add it, but it is a single strategy that can be traded right now. Watched it take this trade yesterday, so nice trade, grabbed 100 points on crude oil in that nice move yesterday. Our Cobra Crude strategy captured about 55, 56 points of this move, but this strategy captured 100 points, so it did a little better. And today it's short, so it's sitting on a loss today. And so it's basically Cobra Crude, which is an existing strategy, a little bit different variation of it, and also includes VWAP. Here's what it's done the last 3 years. Hypothetically speaking, since it's a new strategy, 78.88 average trade profit, 78.90 drawdown. Here is the equity curve and nice recent performance. There's some nice streaks. This streak lasted from November of 2014 through February of 2015. This is a 6-month run right here. You have another nice run right here that lasted December of 2015 through April of 2016. And so we're on a nice streak right now. We don't ever know how long these streaks are going to last. 6 of 2016 through October of 2016. And so here we are in this streak. Let's look at the periodical returns for the year. Annual 8,900 on 164 trades. That has an average trade profit of $54 before slippage and commission. It's a little bit on the low side. Volatility has been low in this market though, and as well the drawdown has been low. So you see there's been very little drawdown also. One of the things that you can take a look at here is the maximum adverse excursion, and you can see the red trades, how much of an adverse excursion. For example, this trade, it was down 650, but it came back and made 1170. And so that's one way to pick your stop loss. So for example, if we want to be aggressive and say let's try to lock into this trend, this with a very low drawdown, can we change our stop loss and make it tighter? So I'm going to change the date to March the 1st, 2017, and show you how to measure that. So here's the equity curve. Here is the trade graph. So you can see there's more trades after about a $350 loss, and so there's no reason to continue to hold trades once it's down $350 when volatility is this low in this type of environment. Here is what it's done in the last 6 months, almost 7 months, and you see nice run, nice low close trade to close trade drawdown. But let's change the stop loss to 350 and see what the results look like. So I've changed the loss to stop loss to 350, maximum trades of 3 per day, and you get a low drawdown 1650, 93.48 average trade profit, which is nice in crude oil. Here is the equity curve, nice equity curve. And so you see there was a winner yesterday and a loss today. And so if you look at the trade analysis, you can see the winning and losing series. It's always best to start a new system after 1 or 2 losses when they show these stats and the drawdown is low. So this is an aggressive approach, and the way you do this is to treat this like a like a trailing stop loss, 1650. So the most you'd risk in starting a strategy like this would be about 2,000. And this does not include slippage and commission, so you have to consider that as well. So say for example you wanted to risk $2,000 to lock into this short equity curve to see if you can get a runner. Once you have $2,000, you can treat it like a break even on the strategy. So you treat it like a trailing stop loss. So if you have 3,000, then you stop if you have another $2,000 drawdown from that point, and you're up 1,000. If you have 4,000, then you treat it like a $2,000 trailing stop loss, and you get out if you're down 2,000. So it's an aggressive approach, but in general, this strategy has nice results the last few years in crude oil. So that's one way to approach it. May add it to the portfolios. It's not in one of the portfolios yet, but it looks like it could provide us with some diversity. I want to check one more thing, a maximum daily trades. change it to 1 and see what the results are. So change the maximum daily trades to 1, and that reduces the total number of trades by 5, and so only 5 days, or maybe not even 5 days. There could have been one day where there's 3 trades because we had maximum daily entries of 3. But it reduces the drawdown even further. And there's the equity curve. So you could try to lock into this equity curve. You could go and trade it on a bigger time frame, the longer time frame. Let's go back 3 years again, and I'll show you that. But notice the average trade goes up by $5 as the drawdown goes down as well by 300. So now I'm going to change the time frame back 3 years. Here it is with the $350 stop loss. The default is $700, so I'm going to put it back to the $700 stop loss so you can see those results. So longer term, only using 1 trade per day actually reduces the average trade profit, which is interesting. So the scenarios where it gets out and gets back in is better in the long run. And so here's the equity curve with that. And so let's change it back to maximum daily trades of 3 and show the results. All right, here are the results. Max daily trades of 3, and so here's the equity curve again. A little bit better if we get out and get back in on some of these trades. You know, crude oil can be aggressive, fast-moving market. You don't want to risk too much, but you don't want to give up too soon in the long run. And that's what that's telling us, to take more than 1 trade per day. And you still have this risk to manage, either through stop loss and money management, or you know, system diversity like we do in the portfolios. But I hope to add this to the portfolio. One or some of the portfolios, I'll let you know when I do. Otherwise, it can be an individual strategy to trade with crude oil.